Hello, Kemi, can you hear me? You're on mute. You're on mute. Can you hear me?
Yes, I can. I can.
Right. I'm just checking my volume. That's all.
Yes, everybody. Can everybody hear me clearly?
Yes, we can.
Can we all go video live? Let's see video.
Put on your camera.
Camille, Mr. Mokide. Yes, that's it. Yes, I got my team ready. Distinguished gentlemen. Yep.
Look, hello, Camille, how now? Long time. How's it going?
Fine, thank you. How's the family?
Good, thank you. Kamal, nice to meet you.
And you as well. Hi.
Good. Sorry, guys, I'm the only one who's not wearing a tie. I thought since we are in lockdown, I haven't worn a tie for 6 months now. So I don't know.
Would you like us to remove our ties too?
I don't know how to tie one. I've forgotten. Yeah. No problem.
I don't think anyone has worn a suit even for 6 months.
Yeah, I had to look for a jacket to wear just now. That's 2 minutes ago.
I flew in last night. I had to look for a shirt, a tie, and a jacket.
Where you from?
I was in Kenya. I was in Kenya for 5 months.
Wow.
That's where I was born and raised. So
okay.
Yeah.
Okay. So
I mean, the clothing industry will be having a bad time.
What's that?
The clothing industry will be having a very bad time.
Very.
Yeah.
Yes, we're live. Good afternoon, ladies and gentlemen. Thank you for joining us for what I know will be an extremely fruitful and insightful discussion about the topic where the interests of lawyers and the interests of society may be diametrically opposed. Before I proceed to introduce our renowned and very distinguished speakers, let me provide some useful context to get us started. COVID-19 has been called many things, but it has also been described as a ticking insolvency time bomb, and I could not agree more. But let us unpack this statement. Over the next 2 years, the World Bank predicts that 90% of countries are expected to face recessions, and every region in the world will be subject to substantial economic contractions. It is predicted that there will be an average of 35% increase in the number of companies that will go bankrupt between 2019 and 2021. Specifically, the United States is expected to experience 57% increase, Brazil 45%, the UK 43%, and Spain 41%. But actually, we need not even venture so far into the future to see the economic ramifications of the coronavirus. Today, we're experiencing economic havoc on an unprecedented scale. Earlier in March, more than 3 million Americans filed for unemployment claims in a single week. In April, according to the British Chamber of Commerce, 6 in 10 companies in the United Kingdom were said to have no more than 3 months of cash left. The Kenyan and South African governments are desperately taking measures aimed at resuscitating several businesses. Bringing things closer to our home, it is well known that the Nigerian economy pales in comparison to the economies of developed countries. And prior to COVID-19, we were already experiencing subpar economic growth, political uncertainty, social tensions. Now, fast forward, 41% of the loans held by Nigerian banks, a total of close to $21 billion, are being restructured. SMEs, which contribute a wholesome 48% to our GDP and account for 96% of Nigerian businesses, have taken significant hits. According to the NBS, that is the National Bureau of Statistics, in the second quarter of 2020 alone, we had an unemployment rate of 27.1%, which is the highest on record. Without a doubt, the effects of this coronavirus and the pandemic will reverberate through the social, political, and legal structures of the world for decades. And while the adequate response to these ramifications will have to be multidisciplinary, one thing that can be done to mitigate and soften the blow from a legal perspective is to ensure that the insolvency process is pandemic proof. And I cannot emphasize that word, pandemic proof. In this session, we shall interrogate issues around business reorganizations, restructuring, insolvency, and the likely emergency government interventions to prevent a liquidity crisis for corporates such as tax deferrals, state loans, guarantees, wage subsidies, and debt moratoriums. Ultimately, distinguished participants, the question we are concerning ourselves with today is simply this: is Nigeria's insolvency regime and its economic recovery initiatives, I repeat, is Nigeria's insolvency regime and its economic recovery initiatives adequate to deal with the pending and looming challenges they face? On that note, I would like to thank our very established and esteemed panelists for agreeing to participate in this very important session on insolvency and economic recovery. I will also thank the Conference Planning Committee under the distinguished leadership of Professor Konyisola Ajayi SAN. I would like to welcome all our distinguished colleagues at the inner and outer bar to this session. Gentlemen and ladies, I guarantee with the caliber of our panelists that this session is the session to be at. And it will be extremely insightful, engaging, and intellectually rewarding. Now, let me introduce to you our panelists. Let me start with Mr. Kunle Elebute. He's a senior partner at KPMG. Mr. Bismarck Rewani, CEO, Financial Derivatives Company Limited, who will be joining us in another few minutes. Mr. Kamal Shah, partner, Stevenson Haywood, a law firm in the United Kingdom, honorary citizen of Nigeria now. He's frequented Nigeria so many times now. Of course, Mr. Camilo Mokide, a top manager in AMCON and now the receiver manager of Aricare. Thank you very much, gentlemen. Let us proceed. The way we will conduct this session is to start with some teasers. I intend to call on my distinguished panelists to give a 7-minute introductory statements. Thereafter, each of them, thereafter I will take 2 rounds of questioning from our distinguished panelists. May I, at this stage, let's respect the non-Nigerian in our midst, the honorary Nigerian, and let us start, first of all, from an international perspective. Mr. Kamal Shah, can you please tease the distinguished participants on what you have in stock for them today?
Thank you, Kemi. It's my privilege to be speaking on this distinguished panel today on the 60th anniversary of the NBA, an organization I have very close to my heart and have worked with extensively in the past. Thank you to the organizing committee and to Dr. Ajayi for the invitation. I am really grateful. And I want to make a few opening remarks today. And I do so having spent 5 months in the lockdown in Kenya, where I was born and raised. And so I do so very much with the African perspective and experience in mind, together with, of course, the UK experience where I am now, having come back to home yesterday. In the UK, March, of course, brought the lockdown as it did for most of the world, and life changed pretty much overnight for all of us. Most businesses shut down and operated virtually if they could, and the others who could not shut down for many, many months, and some are still shut today. Some may never reopen. So besides the human and social impact, the economic impact was life-changing for most businesses, and the effects of that will be felt for many years to come. The UK government provided a host of life support measures to help preserve jobs, to help preserve businesses, and to try and save as many as possible from insolvency. And these included the furlough scheme, which has been extended to October of this year. It included the deferral of payment of corporation tax, which was a lifesaver for many businesses. It included interest-free loans, support on business rates, prevention of eviction of tenants during this very difficult time, and of course, the very important Corporate Insolvency and Governance Act 2020, which introduced a range of measures to help businesses see through the pandemic. It included issues like the temporary suspension of the wrongful trading regime. It included protection of directors and loosening up of some of their duties. It included a moratorium on legal action, giving companies various protections from creditors. And it included a temporary prohibition on winding up petitions arising from coronavirus-related debts. All of these measures have helped to a large extent in trying to save as many jobs, livelihoods, and businesses as possible. Post-lockdown, as we emerged in the UK, it was a more complex situation for the government, and therefore they had to come up with additional measures and more innovative solutions. And this included the extension of the furlough scheme to October. It included initiatives like Eat Out to Help Out, where you get a 50% discount on eating out at restaurants, aimed at reviving domestic restaurants and the tourism business, which was very, very badly hit. It included the promotion of local tourism to help the hotels and hospitality sector revive. And this has been very successful as we see local tourism kick off in a big way. It also encouraged people to go out and spend money to help revive the retail sector, which has suffered very badly. And it included removal of stamp duty for those buying flats and houses up to the value of the first £500,000, aimed at kickstarting the construction and housing sector. It included financial help to forgotten sectors like the arts and the culture, which are the backbone of the UK tourism industry, theatres and all sorts of softer side of the businesses to help revive them, and many, many other measures. So what were the results of all these life support measures? Despite all this help, I think it's fair to say that some businesses and many jobs will be lost. Some have already gone. And despite all of these measures, and I think it's fair to say the UK was at the forefront of these sorts of life support measures, we will see the economic impact for many months and many years to come. Turning now to Africa, where I spent 5 months in lockdown in my home country of Kenya, I think one of our biggest saving graces has been the relatively low rate of infections in Africa. Now, of course, the testing was much lower than many other parts of the world, but the real test is the rate of mortality, and that has been relatively low. We have also seen in recent days and the last week or so a flattening of the curve in many parts of the continent, and we still have a long way to go. But I think that the measures which our governments took early on, curfews, mandatory wearing of masks, lockdown of airspace, social distancing, and the prevention of large gatherings has helped us to get to where we are today. And of course, that has helped us a lot. However, the economic impact has been massive. Many jobs have gone, many more will go. And the fragile economies have remained open because they had to, we couldn't afford to shut them down as some parts of the world because of so many people relying on their daily bread every day. But the economic toll shouldn't be underestimated. As I've said, many SMEs have gone under, many more will. But I think we are seeing some green shoots now as we come out of the pandemic. And in Kenya, for example, the government has introduced some measures to help businesses and jobs. The rate of corporation tax has been reduced. The rate of personal income tax has also been reduced, as has VAT. And like many other parts of the world, in Kenya, we're very fortunate to have a thriving tourism sector, which has suffered a lot. And now the government is trying to introduce measures to help domestic tourism. And that is working to an extent. But there have been no deferral of taxes. There has been no financial support directly to governments, to businesses, to individuals, and no real change to the insolvency regime, which has helped us here in the UK, help businesses, helped individuals. And these are some of the changes I think governments can introduce to really support the measures they've taken so far. And the story is same for quite a lot of the East African region where I was. And I think the governments are still going to struggle going forward. That I hope gives you an outline of the comparisons of where I was in East Africa and of course in the UK where I am now. Thank you. Those are my introductory remarks.
I'm so sorry about that. Thank you so much. Host, you kept me muted for quite a while, so you'll have to give me extra time. Thank you, Kamal, for your introductory speech. Can I call on Mr. Elebuti? Please, can you just give us some teaser again? Host, can you please unmute Mr. Elebuti? Can you unmute all the panelists, please? Can you unmute all the panelists? Mr. Elebute would like to speak now. Mr. Elebute, have you been unmuted now? Please, host, can you unmute Mr. Elebute? Okay, let me, Mr. Camilo, are you unmuted? Mr. Camilo, are you unmuted? No. Host, can you please help me with my panelists? Unmute all my panelists. We have a bit of technical challenge. I think the host is having some challenges on muting all the panelists. Distinguished participants, please just bear with us for another 30 seconds or 1 minute.
Okay, I'm unmuted now.
All right, thank you very much.
Can you hear me now?
Yes, very clearly.
All right, so thanks a lot for inviting me. And I think Kamal has covered most of the points I wanted to mention as well. COVID-19 has not been kind at all to the economy. COVID-19 started off initially as a health problem, but has now moved on to become an economic problem. Most economies of the world, initially when COVID-19 started off, the health minister was one who had the floor, speaking with his prime minister or speaking with his president. As things moved on, it then became the minister of the economy that had the floor. And one of the reasons why they would like the economy to open is to prevent the economies from going from an economic crisis to a financial crisis. If you ever get to a financial crisis, then that is going to be much more damaging to the economy in the long term than just an economic crisis. In Nigeria in particular, not only do we have an economic crisis around COVID-19, but more importantly, around the oil price reduction. As you know, initially a 2020 budget was done on a benchmark price of $57. And then the oil price went down to below $20 by the end of the first quarter. Eventually, we had to resubmit a new budget and bring down the benchmark price to $30 a barrel. Be that as it may, we have a massive fiscal deficit this year in our budget. We've tried to raise money from the IMF, which they've given us $3.5 billion. We tried to raise money from the World Bank there to disburse the money itself. We tried to raise money from the FDB. But as you know, as we give all these palliatives around trying to reduce taxes or trying to deliver when companies can fight tax returns, what therefore means that government revenue itself is challenged. Specifically, the FRS has given some tax measures in Nigeria. First of all, extension of deadline of filing VAT returns from 21st of each month to last day of the month, extension of due date for corporate income tax filings, allowing companies to file income tax returns with unaudited accounts, suspending field audits and investigations and monitoring exercises, alternative tax payment options for taxpayers facing difficulty sourcing FX, electronic filing and correspondences. These things will save some cost for companies and conserve some cash, but only those companies are tax-paying companies. And then, of course, there's an emergency economic stimulus bill before the Senate, which is to try and reduce taxes on PAY by 50%. But of course, to do that, you need to get state governments, to agree. And many state governments are challenged because they don't have enough IGR, as the case may be. So, in Nigeria's case, it's even what we call a twin shock. You have the COVID-19 shock and the oil price shock. And what does that mean? There are some industries that are going to be severely affected. So the airline industry, for example, has been severely affected. Okay, you've got any kind of hotels or restaurants have been severely affected. A lot of SME businesses have been severely affected, and many of these businesses are in the informal sector. And typically, what happens is when government gives any kind of palliatives, any kind of incentives, those incentives are really to be taken into account by the formal sector. Informal sector activities typically cannot access government incentives because they don't pay taxes. The government doesn't recognize them, that they exist. And a lot of Nigerian employment happens in the informal sector. So what does that lead us to in terms of insolvency? I think what's going to happen here is that you're going to have business failures. First of all, I can take insolvency in three different buckets. There's a phase the business gets to where the business is challenged financially, but if the business can restructure its finances, it can get back into business. So take, for example, Nine Mobile. Nine Mobile had a challenge with its lenders and the financiers. It was able to restructure its finances and bring in a new investor and recapitalize the business and go back to trading. Okay. Then there's a point of, if you go beyond that point and you're not able to restructure, then you become insolvent. Okay. And then post-insolvency, under insolvency, with the various laws that we have on our books, again, you can talk to creditors, you can talk to lenders, and so on and so forth, and try to see how you can restructure your business. And if you still cannot do that, then you get to a business failure. Or when you fail, you go into liquidation. There are some businesses under COVID-19 that will go straight to business failure because they have no business at all existing. And there's nothing you can do. Nobody's going to put any money into those businesses at all. Nobody, and the reason why, they have no customers. If you have no customers as a business, there's nothing anybody can do. Customers generate cash flow. So if you have nobody can pay for your services, nobody's buying your products, then you've got no business. You go straight to business failure. Okay. If you have some customers or you have reduced cash flow, then you need to restructure, or you need to go through insolvency and lay off people and restructure your balance sheet, reduce your overheads, move from VI to Oshodi, for example, or anything you need to do to save costs for you to go back into trading. If you get to a point where you need to restructure and you still have a business and you still have customers and you have cash flow, but the cash flow you have cannot pay your current structure, capital structure. In other words, your debt is too short in tenor, or the interest rate is too high. Then if you do a debt restructuring, where you take the debt from 2 or 3 years to maybe 7 or 8 years, for example, or for example, you're able to get a lower interest rate, for example, then you're able to stay alive, in effect, with a new type of agreement with your lenders and your creditors and your suppliers. And then you don't have to go to insolvency. So what are my own piece of advice here? Every business goes through a typical business cycle. Okay. And what is the business cycle? The typical business cycle is where the business is established and there's fast growth. And then it gets to a point where the growth begins to flatten. And it flattens because of competition. So you can imagine the telecoms industry initially, when MTN and all the other players came on board, was a fast-growing sector, ramping up significantly, ramping up customer base, very strong cash flows, and then you get to a point where it becomes very competitive, and then it flattens up, the growth flattens up, slower growth. Every business needs to reinvent that curve. Okay, you need to reinvent that curve again into find a way of getting back into fast growth. Okay, if you can't, and you're flash growth, then most likely, if you're not careful, either you restructure or you may become insolvent, which is why you have M&A, you have mergers and acquisitions. Okay. Secondly, also, businesses must reinvent themselves throughout your business life cycle. You can't just remain static, doing the same thing forever. And then finally, the capital structure that supports your business growth through the business cycle will always change based on where in that business cycle. And you must really be sure that you have the right capital structure to support your business at the right time. Thank you.
Thank you so much. I must say on a lighter note, Mr. Liberty, if you were a prosecutor, your accused person would have collapsed out of high blood pressure even before conviction.
Sure.
You put this so bluntly to us. And I'm not sure whether Mr. Camilo will be that optimistic anymore about the present position he finds himself with Arik here. What are your thoughts? And could you give us a teaser as to what we should expect when we get to the Q&A session?
Okay, well, I would like to give first of all a historical perspective. Let me stay on already established protocols. I thank the organizers for the opportunity to be part of this August conference and to have the opportunity to air my views. This pandemic First of all, nobody expected it. At least in Africa, we actually thought it was a joke. I'm sure nobody expected that something would be as significant as this. More like, creating a wartime situation in a peacetime situation. And historians say that the economy has never suffered this level of shock as it did, since 1929. This is the worst shock. The last quarter, especially quarter starting April to April, May, June, where you can add July, have been the worst in the history of the world in recent memory. Not even during the 2007 to 2009 global meltdown did we see such drop in the capacity, in the business capacity of the world, or in the earning capacity of the world. I mean, so things have really been tough. Many people in this situation usually will talk about us, i.e., the airline industry, the hotel industry, the tourism industry. It is true, but have you thought of it? Every time something like this happens, it affects the banking system. Yeah. Like you just reeled out, if you are restructuring 40% of your loan book, you are basically in trouble. Mm-hmm. So what I see more than anything else is that we need to give a lot of focus to the banking system to make sure that it remains healthy, because it is when there's a problem in the banking system that you really have a significant financial crisis. It will be a contagion. You just have domino effect after the other and things like that. I know that the central bank has been doing a lot of work to keep the banking system intact, but I tell you that for anybody that is watching the economy, that is one place to watch. If we are able to navigate the banking system successfully out of this crisis, I'm sure to a great extent, all other sectors will navigate and come out one way or the other. Definitely, many people have been talking about the new normal. The world may hardly never be the same again. I know that people currently are very afraid. They don't want to travel. And so you see that even when you put planes in the air, you don't have enough passengers. You don't have people wanting to fly. And like Mr. Kunle said, if the demand is not there, there's very little a businessman can do without the support of demand, especially in this case, we talk about passengers. The airline industry is going through a lot. It's not, maybe I shouldn't say everything now, but I can tell you that with us in Nigeria, our operations is down to a little below 50%. Below 50%. We have had to, like they do in Europe, for long staff. We ask them to go, but like in Nigeria, you don't have social safety nets. So this there's no government support to provide them any form of cushion when they go out. So you have people that are out of job for 2 months, 3 months, 4 months running, and so perhaps that is why some other businesses are not doing well, because they don't even have the money to buy. The implication is huge. You also have challenges with defaults. Thank God for CBN, but the airline industry does not deal with CBN alone. You also have international partners who do not show as much understanding as you get from CBN. But so you have loan defaults occurring. You have service agreements, vendors, people that service your planes, that give support. In one of those cases, one of those guys that supply spare parts, they basically bailed out on us. That's the way I put it. I'm sure somebody conducted a risk management analysis and said, "Oh, Africa cannot survive this," and the guys ran away. So, that means so much chaos. So it's But it's also a time to test the quality of management in institutions. It's a time to know how strong leadership is, the leadership that can navigate difficult times. So as difficult as the times are, I see it as an interesting period for various people in various sectors to showcase their leadership potentials. In ARIC, it's been challenging and interesting. Maybe as the program goes on, I may be able to go into some of those challenges. But I can tell you that as it is for ARIC, that is how it is for other airlines in the industry. The staff are having a very tough time, and the shareholders, nobody's talking about returns anymore. You just want to survive. So where we are now is a pure survivor mode. As Fela would say it, we suffering and smiling.
Thank you so much, Mr. Mokide. I'm beginning to wonder whether I should fly again. Maybe I should start using road transportation.
Just don't pass through Kogi State.
I must, distinguished participants, I must welcome Mr. Rewani. Like I did promise that he was going to join us. Mr. Bismarck Rewani, you are a very familiar face to every much of economics in this country. We've always enjoyed you on Channel's program whenever you are called upon for one interview or the other. The participants are quite privileged to have you as part of the panel. We are taking some introductory statements. Could you please just give the participants a teaser of what to come? You have 7 minutes to do that, sir. Hello, Mr. Rewani, can you hear me? Can the host please unmute Mr. Rewani? Please unmute Mr. Rewani. Sorry about that, Mr. Rewani. Just a minute. I'm sure they'll get to it now. I will send them messages.
Okay, I know I'm unmuted now.
Yes, thank you.
So good afternoon, ladies and gentlemen. It's interesting that we are speaking at this time in the country. We had our GDP numbers come out on Monday. We also had the impact of COVID by the Nigerian Bureau of Statistics. And just this afternoon, I think the South African government announced that they expect a deterioration or contraction in the economic activity by as much as 20% this year, and even going further. So what I'm going to be talking about basically in these few minutes is that what's happening in the global economy, what's happening in the regional economy, what's happening in the Nigerian economy. And I'm going to be focusing on one, the impact of COVID. Before that, I will talk about the pre-existing conditions of the Nigerian economic ailment before COVID. And I'm then going to talk about the resilience of the economy and then the outlook. So let's start by saying that globally, I think the EIU came out today to announce what the global forecast is going to be, not for the entire world, but for different countries. And from what I have seen, of the only Indonesia and China were spared the deterioration in economic activity. The one that is going to recover fastest in their universe is South Korea, which will recover on the third quarter of 2021. After that, almost every other country, Turkey is first quarter 2022, Australia is first quarter 2023, United States is third quarter 2022, Brazil and Canada, most of them are 2023, 2022. So what am I saying? I'm saying that the this is going to be a long drawn out journey to get back. And this is when they will get back to pre-COVID conditions. So averagely speaking, we should get ourselves ready for a deep dive, actually a deep drop, languishing at the bottom, and eventually getting back. Now, what does this mean? It means that our trading partners, if you look at these countries that are the earliest of our trading partners are going to recover, is probably China, which is not stated here. When you look at a country like India, India is expected to recover first quarter 2022. So if you pair us against our trading partners, and those are the guys who buy our products, who drive our external balances. So we have India, the European Union, we have Japan, we have the United Kingdom, and almost all of these countries, the average time of recovery of these economies to pre-COVID conditions is well into 2022. So whilst the Nigerian economy will be struggling, dealing with its pre-existing conditions, dealing with the structural defects, dealing with its operational problems, we live in a global world. We should be looking at our global partners, trading partners, recovering in the middle of 2022, and that is when we will begin to see some impact. So that is the first thing. Secondly, on the African continent, South Africa is expected to recover. They just announced it. Recovery is scheduled for Q4 2024. Q4 2024. That's the second largest economy in Africa. We have the African Continental Free Trade Agreement. We have the ECOWAS protocol. We have the problems happening in Mali. We have Ivory Coast, which is tinkering on. So as far as the African continent is concerned, we have our ECOWAS problem. We have our Continental Free Trade opportunities, but there's not going to be much joy coming from the African countries. Of course, our borders are still closed. I expect that to open. Now, coming to the Nigerian economy itself, first thing we must notice that the Nigerian economy had pre-existing structural defects and conditions. We're growing at a rate lower than our population growth rate. The country was beset with multi-dimensional poverty, which actually, we're talking about multi-dimensional poverty averaging 73% in the northern part of the country and about 28 to 30% in the southern part of the country. When I say northern part, just northeast and northwest. If you take the north central away from there, then put them among the south, then you have that. That was one. We had rising inflation. We had interest rates which are negative, interest rates which are 11% lower than our rate of inflation. We had external weaknesses. The terms of trade were against us. So we know the problems. So what has happened in 2020 is that the policymakers have used this as an opportunity, one, to deal with the structural defects of the past and deal with the operational problems, the COVID problems, and also use the opportunity to kind of improve competitiveness of companies and comparative advantage of the country. Unfortunately, the dose that is being administered is probably much less than is adequate at this time. So the intentions are good. The psychology of not being in denial is there, but the capacity to take that big leap is what is coming. I don't say it's missing. It is, it's slow to accept that reality, and I think that will come. Now, we have the fiscal shock, we have external shock, we have a productivity gap, and then we have also the external currency misalignment. All of these things are going to be addressed. They cannot, you see, the approach of partial equilibrium analysis is different from the approach of general equilibrium. We've used the partial equilibrium where we think we can hold one variable down and then control the others. You cannot hold any variable down. Now is the time to do all of it together. So what am I seeing? I'm seeing that if you look at the growth numbers that came out, we saw that growth of the 46 activities that are monitored by the National Bureau of Statistics, only 13 grew positively. All other 33 of them grew negatively. That's even much worse than what happened in the first quarter. So I expect that, of course, the second quarter is ending next month. And the second quarter, clearly we are in recession, we are in negative growth. We're going to we are in the third quarter right now. So the third and fourth quarter is going to be negative, or maybe with some luck, the depth of the negative growth and contraction will be less than what we saw in the second quarter. Why do I say this? I say because oil prices have gone up from $28 a barrel on the benchmark. It went up to about $35, $38 a barrel on during the second quarter. And now it's averaging about, in fact, this afternoon, Brent crossed $46. So there is some joy there. However, our production, being able to comply with the OPEC quota means that our production has also dropped. Generally speaking, the basic things are better than what they were in the second quarter. But don't forget, we only shut down on the 30th of March. So we've had one full quarter of shutdown. The lingering effect is going to be here, third quarter, fourth quarter. A realistic assumption of coming back to positive growth at best will be in the second or third quarter of 2021. Well, that being the case, there are some things that need to be done and done immediately.
Thank you so much, Mr. Rewade. Thank you so much. I won't let you go so quickly. You have painted a very gloomy picture of the world economy in crisis. You've also told us in not so very unclear terms that Nigeria's economy is heading for some form of recession for a second time in 4 years. What do you think we are not doing right at the moment, which is germane towards economic recovery? And what steps or approach would you recommend to the government to reflate and stimulate economic growth at this time?
Okay, let me answer. First of all, it's not what you're not doing right. This is a crisis. So everybody in the world is affected. The only thing is that this will be our second recession in 4 years, but our third recession in 10 years. Okay? Yes. So every time there is a recession, two things happen. You get scarred, but also you should learn lessons from the last one. The first one of 2008 and 2009, we didn't learn our lessons. In 2016, we were in psychological denial. We were in the early stages of the grief. The 5 stages of grief were in denial. But this time, we are not in denial, but we are afraid of taking that big leap in certain things. But I think that is short-lived. Nigeria will take that big leap. Nigeria will deal with both the structural, tactical, and operational issues. We have no choice because the alternative is a catastrophe. So I'm optimistic about that. And because potential GDP is growing faster than real GDP, your ability to catch up is better. However, you have the problems, like I said earlier on, of multidimensional poverty, no shared prosperity, unequal opportunity, and lingering in the background are social and political vulnerability. So in that situation, when you want to take a big step, people will interpret motives and all of that. But I think we don't have the time for that right now. Luckily, the president is ineligible for election and he does not intend to contest any election. Therefore, he will have no choice, and he has said it categorically that he will do everything for his legacy to take 100 million people out of poverty, maybe 10 million this year and 10 million next year. But more than anything else, we have to deal with the things that will increase investment, because the economic sustainability plan is anchored on 2 pillars. 1, government expenditure and palliatives. 2, consumption by the people. The missing link is investment. So we have to do everything to bring investors into the pool. When I say investors, I'm talking about domestic, international, and diaspora investors. Because once you don't have investment, you will not have that linkage and you will not have the multiplier. So that is going to be done. How are we going to do it? We are going to do it in so many ways. 1, the PPP projects that I mentioned. It's not about ease of doing business, it's about taking actions to motivate investors to bring your money. We would have to pass the PIGB immediately, and I think that's going to be that. we will have to incorporate the joint ventures and have some things there. We would have to unify those exchange rates, whether we like it or not. It's not what we want to do, it's what we need to do. Please mark my words, not what we want to do, it's what we need to do. We will do that in good time too. The cost reflective tariffs in electricity, because that is critical, will be adopted with new investment restructuring that sector altogether. So I'm optimistic that the policy initiative will be there. It's just a question of taking those big steps at the appropriate time before further damage is done. That's my view.
Thank you so much. Distinguished panelists and esteemed participants, I've had this word used by Mr. Lebute a few minutes ago, and Mr. Rewanitu has also re-echoed that word about flattening the curve. Mr. Camilo Mokide, it is important to flatten the curve and use relief measures to prevent viable firms from being forced prematurely into insolvency. What do you think the government's approach should be on this? Can the host please unmute Mr. Camilo Omokide? Can you please unmute Mr. Omokide? All right, let me go to Mr. Shah. Mr. Shah, I know you're unmuted. Is that, am I correct?
That's right.
All right, Mr. Shah. Host, while I'm discussing with Mr. Kamal-Shah, please Mr. Omokide. Mr. Shah, what is your experience in relation to African banks who are facing difficulties with their borrowers who plead lack of fund or insolvency? What is your experience?
So I think it's fair to say that every single one of our banking clients, whether they are from Africa or elsewhere, are facing challenges which are unprecedented. The ones we advise in Africa probably break down into three geographic areas: West Africa, East Africa, and then offshore places like Mauritius. And the issues they are facing over the last 6 months are fairly similar, and the trends which have emerged are also fairly similar. And they break down into about 5 or 6 different areas. The first is NPL book challenges. Every single one of those banks have been using the NPL word many, many times in the last 5 or 6 months. There are increased challenges with managing the NPL portfolio, and almost every bank that we have advised has said that it is increasing. So there are complex challenges around that. Someone mentioned the 40% figure, and that's probably around right. Combined with that then is the issue of borrowers asking for all sorts of exotic initiatives on the part of the banks. So restructuring, payment holidays, and insolvency if all else fails. And of course, some of the UK banks have been offering payment holidays, whilst many of the banks in Africa are not able to do that except for a subjective basis. So there is that. And there are some genuine businesses who have been supported by the banks and continue to be supported. But equally, for every genuine case, there's probably 5 dishonest cases who just want a payment holiday or a restructuring for the sake of it, even if they're not suffering. And then there's the issue of due diligence, which has been exaggerated by this crisis. And banks are going back to their initial paperwork of what DD they did at the outset when they were giving the loan, or what due diligence they've done during the course of the loan, and often finding that actually the paperwork wasn't complete, the assets weren't quite in the direct name of the borrower group or the promoter, and there are therefore difficulties in chasing the loans and commencing legal proceedings. So we're advising banks on how to enhance their due diligence processes, and a number of cases in the past 6 months have involved us working with private investigators abroad to try and establish asset bases and footprints of the promoters and the groups in jurisdictions like the UK, Switzerland, Dubai, elsewhere, so that the banks can then go back to these borrowers and actually say, well, you were pleading insolvency locally, But actually what we have found is the following: real estate in your name, or found out that you have a lavish lifestyle abroad, and that helps them to negotiate with the borrower groups. So due diligence is actually going to become extremely important going forward. And then there are cases where borrowers have borrowed from multiple banks, and actually the size of that total borrowing is enormous, going into the hundreds of millions of dollars, or in some cases several billion. And none of the banks, each of them on their own, haven't quite realized what the outstanding is. So when defaults start and they look at the paperwork, they suddenly find that they are one of 10, 12, 30 banks maybe, and working out where they are in the queue and in what pecking order, and if they call a default, whether that leads to a domino effect of insolvency situation of the borrower. So these are very complex questions that we're having to deal with on behalf of the banking clients, and in some cases, suddenly finding that there's been massive fraud within the borrower group, whereby they've borrowed billions of dollars, and suddenly the whole pack of cards is coming crashing down. And the last is, of course, that none of this has a textbook response. A lot of what we are facing and our clients are facing is novel situations. So having to think on our feet, clients having to really make calls that they've never made before. There is no precedent for this situation created by the pandemic. And also, they haven't faced such a fast-moving situation. So we might get instructions today on one aspect of the situation, and tomorrow the whole situation will have changed. And so that fast-moving pace, boards are having to be called in the middle of the night to make decisions. And so it's very complex, very fast-moving, and unprecedented. And we, like our clients, are working to work out the best solutions for them. So these are some of the trends we've seen. I'm sure as time goes on, more will emerge, but that's broadly what we've seen. Thank you.
Thank you, Kamal. Thank you, Kamal. Mr. Liberty, I'll come back to you in a second. Mr. Kamilu Amakide, I'm back with you. Could you please, I was asking you earlier on that it is important to flatten the curve and of course use relief measures to prevent viable firms from being forced prematurely into insolvency. What do you think should be the government's approach, considering the fact that you are presently in ARIC air and you must have some experiences too?
Okay, I'll speak generally, but as much as possible, I'd like to speak in relation to the aviation industry. Yes. I've said something about the banking industry. I'm sure AMCON, CBN are all watching carefully to make sure that defaults do not spiral out of control and imperil the stability of the banking system. The banking system is key. It's the engine room of the economy. If the banking system fails, like I said before, you're going to have significant problems. Contagion, it will affect different industries, and it will be not very difficult to manage. So the Central Bank of Nigeria must continually give focus and support to the banking industry to make sure that it does not fail, because it is a strong banking industry that can support other sectors of the economy. I would like to say the operators of airlines in Nigeria have approached government already and said, like has been advised by IATA and other airline associations around the world, that it is not possible for Nigerian airlines to come out of the challenges of COVID without support. I dare say that to some extent, that situation will also be true for many hotels in the country. I've fortunately read today that the Central Bank of Nigeria is at the verge of giving some level of support. We have not heard much from the Ministry of Finance in terms of what they are able to do. There needs to be a concerted effort between the Ministry of Finance and the Central Bank of Nigeria to arrange different kinds of support. Generally, the support that the industry needs can come from two sides. One, fiscal support, that is by way of some level of tax relief. Over time, the government has in principle agreed that they will waive VAT for the airline industry. But I can tell you that till today we are still paying VAT. And that is a cost. It looks small, but airlines that can make 5% income on sales, they will actually go home happy. If an airline can make 5% income, I mean, EBITDA on as the proportion of the sales, they will go home happy. Currently, that is not happening. So if you give the airlines 5%, 7.5%, it will go a long way to helping them stabilize. That has not been done. In ARIC, let me just in ARIC, at the beginning of the COVID lockdown, we had to fall on about 90% of our staff. We had about 1,700 workers. So we retained only about 170, and the remaining we asked that they should go home. In the first month, we were able to manage. We paid them some portion of their salary. But in May, we couldn't. In June, we couldn't. In July, we couldn't. We only were able to pay the people that were working. Now that operations have opened, we've been able to recall about 40% of the workforce, and we still have the rest out there. You don't want to hear, the trouble we'll go through on that. If I am government, what will I do? Some people say I'm actually part of government. So what will I do? The same way, the same focus, the same discipline, you have organized a COVID response center where the Minister of Health and his colleagues are addressing the nation. That is the same level of concentration government needs to give to reviving the economy. So you have a team fighting the health challenge. You need to have another team working assiduously, informing the nation, bringing suggestions, providing solutions to the challenges, the economic challenges arising from COVID. If that is not done, if there is no concentration, if it is treated as another job, assuming that things will turn around on their own, like Mr. Iwani has said, the outlook is not good. Things do not look like they are going to turn around soon. Because of limited time, I would like to push an idea out that I believe can help Nigeria a great deal. And I think this is the best time for it. The Minister of Aviation has been working quite hard and recently tried to set up an airline leasing company for the country. It has been quite difficult to achieve that. I know it will remain difficult because, the truth is that government does not have so much money to vote for this kind of thing. But I see a way for the Nigerian banking system to take charge of that process. You have so much of the Nigerian banking funds or deposits being sterilized in CBN. Instead of just sterilizing those funds, the Central Bank of Nigeria, working with the Minister of Aviation, working with the Committee of Banks, should set up an airline leasing company that has the muscle, the capacity to buy planes, to buy engines of different types, and be able to support the aviation industry. Ordinarily, as of today, almost every bank in Nigeria has removed lending to the aviation sector from their credit policy plan. Of course, because they've suffered losses. But the best way to intervene in the airline industry in Nigeria is not just to be lending, retail, doing small lending to the airlines. The most important resource the airlines need is planes. So what should be done is that government, working with the private sector, that is the Nigerian banking system, should come up with a system that enables Nigerians to buy planes. Then after buying the planes, you need to de-risk it. The major risk, another major risk that has ensued as a result of this crisis is FX risk. Before the crisis started, we were at 360. Now we're at 480. going to 500. There's just so much you could do to transfer costs to the public. So if these things are not measured, you discover that what you have is that most airlines in the country will struggle. So we need to set up that infrastructure that enables Nigerian airlines to have access to a stock of planes.
Thank you, Mr. Mokide. Thank you so much.
All right.
Thank you so much. I know that if you can use a whole day to alert us on some of the issues.
Yeah.
But Mr. Elebote,
yes.
Granted that with COVID-19, the rate of default and insolvency has become exponential.
Yeah.
A school of thought believes that a lot of companies have always defaulted. The default has always been high. Now, premised on your wealth of experience, working with several companies, what can you say is actually the root cause of insolvency cases in Nigeria, and how can they be addressed from a company perspective?
Thank you so much, Kemi. Let's be frank. For me, there are a number of causes. I would say high on my list is lack of corporate governance. It may sound, it may sound unusual, but that's reality. That's what we see. Where companies don't have the adequate corporate governance, you're not even sure when they borrow money that the money that they use it for what they intended to actually, said they will use the money for example, on the one hand. Secondly, also, you're not even sure that when you have cash flows coming in from customers, we see, cash flows being diverted away from, paying obligations and meeting their regular obligations. And you see, for example, where management goes above the approval limits that's set by the board. And in many cases, the boards of many companies are just, have been handpicked by management. And many times the board are just camouflage boards in effect. So with all those things in place, very weak corporate governance, any lender that lends to a business where the corporate governance is very, very weak, the day that money was disbursed, the day that loan was granted, that loan went bad. You may think that the loan performed for a period of time, but reality is that there's no intention to repay that loan by that business. And that is the case. You've been a research manager yourself, and I'm sure in your experience, when you look at the root causes of those researches you've done, it's just, even where the company has the ability to pay, where there's cash flows, where there's customers, you just find that the owners of the business do not want to pay. And that's because there's no consequence management for doing things which are not correct in this market. And it takes you back to when we had the Emir of Kano, former Emir of Kano, Central Bank governor, where he intervened in the banking industry and took out 9 banks and took out the management teams of 9 banks. Again, in all those cases, that was what created AMCON, as you know. In all those cases, it was primarily lack of corporate governance. That's one. Second area is, for me, is typically in any business, the sector in which you are operating can be challenged. Okay, and the sector can be challenged either because of competitiveness, or comparative advantage, imports coming into the country from outside, poor government policy. All kinds of factors can affect that sector, both macro and micro. Now, unless you have the right capital structure to be able to, see yourself through those challenges, your business can be challenged for sure. And you have too much debt, and what you need to do is actually increase your level of equity, and pay down some debt so that you have a buffer. One of the things that we need to do in this COVID-19 period is the word resilience. That we ask businesses, how resilient is your balance sheet? In other words, your resilience means that, do you have enough cash flow to meet your obligation for the next 6 months? Even if you have 0 customer base, could you meet your obligation? Could you pay salaries for the next 6 months? As you saw with the airline industry, as soon as people stopped flying, maybe they had cash to pay 1 month's salary, boom, that was it, end of story. So before the COVID-19, many businesses were not conserving cash. And even if they had cash, was that cash diverted as well, okay? So if you add those two together, corporate governance and inconsistent policies or competition or imports or so on and so forth, or inability to be able to meet the shocks of oil price increases, for example, or the shocks of the currency devaluation, or the shocks of interest rate increases. So if you don't have those things, any of those things will cause you to end up in a point of insolvency. Now, however, one last proviso. Before you get to insolvency, every business knows that there are signals that are showing in your P&L and balance sheet for you to take action, for you to step back and say, I need to restructure. I need to go to shareholders to get more equity. I need to pay off certain debt. I need to sell non-core assets. I need to reduce my headcount. That restructuring stage, many businesses don't take it seriously. And two, lenders, for some reason, are not able to go to their customer and say, customer, we can see that your inflows are reducing. You need to restructure. We're going to force you to restructure, or if you don't restructure, next stage is insolvency. So many businesses don't take restructuring. Like in the US, they have something called Chapter 11 under bankruptcy acts, where you can have protection for a period of time. You can restructure. You can negotiate your terms of your creditors and your suppliers and so on and so forth. You can sell non-core assets and then come out as a business that is solvent, that has positive cash flows. So we don't take that restructuring phase seriously enough in this market. If you spend time doing that properly, many businesses will not progress to insolvency, and they will survive.
Thank you so much. Thank you so much. Mr. Rewani, thank you for your back. Recently, on the 14th of August, 2020, the CBN reported that 22 Nigerian banks submitted requests to restructure over 35,000 credit facilities of businesses that were negatively affected by the pandemic. Those requests represented over 42% of the industry loan portfolio. It is then obvious that financial institutions should still expect a steep rise in the average non-performing loans in the days ahead. If you were the managing director of a financial institution or a company, what would be your advice?
About restructuring? The reality is that if you look at during the 2009 crisis, 2008-2009 crisis, that started from the subprime mortgages, there was accommodation and restructuring and forbearance. Restructuring is different from forgiveness. If you are restructuring facilities, nobody's writing off these facilities. It only means that there are two angles of it. One is that the central bank will allow you some latitude in terms of your impairment and compliance with the IFRS and all those conditions. Two is that the money, you get the money back. Interest will be suspended, and then, interest payments, there will be a moratorium on interest payments, and then you will claw it back subsequently. But these are extraordinary situations. It's more like a force majeure situation. But in this case, the government and the policymakers, the central bank in particular, are saying that if you comply strictly with the letter of the rules of impairment and things like this, you are going to have a situation where you will have very clean balance sheets, but also many banks will go under. Also, many companies will go under. So it is for macroeconomic stability that the central bank is insisting that loans should be restructured, because these guys did not go and bring COVID from anywhere. It's an extraordinary situation. And then after, as we begin to reopen, it is expected that many of these things will be restored. But even before COVID, we had a situation where Nigerian customers were already in default, and there was no name and shame. There was a free-for-all going on, at times in connivance with the banking institutions to rip off the banks and the shareholders. But the moral hazard is what I'm trying to point out here. The moral hazard can come back to bite us, but I don't think it will, because, again, the newcomer, the question of the receiver managers and all of the old voluntary and involuntary liquidation or winding up activities, all of these things are being put in context. And the fact that with social media and open access and open architecture, it is not possible for you to, on one hand, be in default, and on the other hand, be borrowing somewhere else. That used to happen in the past, but now everything is open. And so I am confident that we are going to be doing things better. And that doesn't mean there will be dysfunctional members of society. But as long as the dysfunctional members of society are only at the fringe, maybe 5, 2, or 1%, you cannot have a situation where the dysfunctional members of society are 60 or 70% of the community. In that case, you see, the madmen will take over the running of the asylum from the asylum keepers. And that's what we are trying to stop.
Thank you so much. From experience in insolvency, I do also agree with you that restructuring does not mean forbearance. Oftentimes, I also notice, and I hate to say this, that even where companies have been restructured, like Mr. Elibuti had pointed out, where there's poor corporate governance and there's no structure in place, these companies still go into default. But having said that, Mr. Kamilu, are you with Mr. Kamilu?
Yes.
Now, what level of control do you think we need to incorporate into our corporate governance code for financial institutions to curb wastage at this time and ultimately boost economic? Sorry, this is for, I'm giving this to Mr. Elibuti, I'm sorry. I will come to you, Mr. Omokide. Mr. Elibuti, because you touch on corporate governance, and I want you to address this for us.
Yeah.
What level of control do you think we need to incorporate into our corporate governance code for financial institutions and even companies to curb this wastage that you have highlighted and ultimately boost economic recovery?
I think, let me link back to what Kamal said around due diligence. And I see it as well, that lenders in this economy and in other emerging market countries, because banks are under pressure to post results, banks are under pressure to lend. They don't do adequate due diligence. Because if you do the due diligence of a business, can you imagine if you want to make an investment, if a PE investor wants to invest in a business, they will spend money on very detailed due diligence, legal due diligence, financial due diligence, technical, operational, HR, even look at the board and structure. And on the back of that due diligence, if they want to invest, they make an offer with conditions that you need to put X in place, you need to put Y in place. Oh, I want to have the CFO role, for example. I want to do this and that. Lenders need to take the same perspective as well. Now, other than large multinationals, other than established businesses that have a track record and adequate corporate governance, when you're going down market to the next level of businesses which are higher risk than the top end, there needs to be much more thorough due diligence around how you want to structure the financing. And you can actually make demands and say, oh, we're going to appoint an independent finance CFO, for example. We want to ensure that all the cash flows are going to one particular place. Okay, we want to have a number of independent directors, and we want to have a say who those independent directors are. You got a point. We want to know who the signatories are of the bank accounts. And if you don't meet these conditions, look, in the same way, IMF wants to give Nigeria a loan. Do you know the conditions they'll give you for IMF before you can get an IMF loan? It's no different from a lender who's protecting depositors' money to do adequate due diligence, use that due diligence to be the terms and conditions for the facility. Now, once it's embedded in the agreement between both parties, you don't need corporate governance. What you need is in the agreement. I have been in a case where, for example, a customer was almost going to default. I was the auditor. I went to the lender. I told the lender, you better put some money on the board. You better monitor this business much more closely. Otherwise, this business is going to go down. And they did. Plant was in Ibadan, bank was in Lagos. We used to go together to Ibadan for board meetings on a monthly basis. We used to get the management reports. We used to query their decisions because they were exporting, okay, but they were under invoicing. And we knew that what the prices that they were quoting was a lot lower than what they should actually be getting, and therefore was affecting their cash flow. So banks have the powers to step in to curb wastage. They have the powers. But my view, I just think either just laziness, or as Bismarck said, there's collusion between the lender and the borrower. You got a point. And they think that if they have enough very large corporates on their loan book, they don't need to bother too much about it. They can afford the NPLs from the next level of businesses. That's my view. But there's nothing that says that they can't actually step in to reduce all those wastages.
Thank you so much. Since you brought in Mr. Kamal, since you brought in Mr. Shah, Kamal, I'm going to put you in here. Now, what has been your experience with African clients in English courts?
So it's been a mixed bag. I think it's fair to say we have some clients who are just sitting on the fence. They are totally shocked themselves with what has happened. They don't know how to react, can't react in a state of paralysis, or there's no one within the boards to take leadership and make decisions. So those I put in the sitting on the fence category, and they will probably regret not having these systems in place to make fast decisions, because by the time they do, it will be too late. There will be nothing left to salvage from the lending that they have, no assets to secure, etc. The second category, which I think we all have had experience of, is the ones who fall into the amicable discussions basket. They're trying to be nice to their customers. They're trying to talk to them. They're trying to have virtual meetings and try and resolve the situation. And now, as we all know, with virtual meetings, settling a situation is really not ideal. You can't read the body language. You can't look people in the eye as you would face to face. And so settlement discussions virtually are proving actually very difficult. And clients, or the defaulters or the borrowers, on the other hand, are using that to say, look, we can't travel. I can't come and see you. Let's have a virtual call every week and we'll discuss how we can resolve this amicably. What we're finding is actually stringing out the banks to a position where it is too late for the bank to take any action, any formal action, and therefore have to roll over to the client's demands to restructure, or even worse, to lend more money, because the client says we need X amount more money to get us out of this situation. So it's a never-ending vicious cycle. So actually, we're finding that amicable discussions, unless they really are in good faith, many are just using those to stretch out a bad situation to make it even worse for the banks. The third is actually banks taking very proactive steps and filing actions in the UK courts where they're able to establish jurisdiction. And many of our African banking clients, particularly the Nigerian banks, have started to have non-exclusive jurisdiction clauses in their agreements, in corporate guarantees, in personal guarantees, which gives them the ability to file an action outside of the local jurisdiction where the borrowers do not have the ability to influence the system, or to delay court proceedings, or any number of other measures which may be possible in some local jurisdictions. And so the UK courts have been quite busy with receiving filings from certainly the likes of us, and I'm sure some of our competitors as well. And the other thing I think we should not forget is it's not just the problem of the government or the problem of the central bank. I think it is also incumbent on the courts, the judiciary, to process these applications coming by lenders or corporates who are trying to salvage the situation from dishonest borrowers or other counterparts, because the courts can play a very, very important role to salvage a bad situation from making it even worse. And so the courts in the UK, for example, have been working virtually throughout the pandemic. We have had many, many hearings by Skype, by Teams, by any number of platforms where the judges have had the hearings, done the cross-examination, and rendered judgments very quickly. And in some cases, freezing order applications and had the orders given virtually, which in the past would be very difficult. So they have played a very important role. And I think some of our clients have realized that rather than filing proceedings locally, wherever that may be, filing in London, where the courts are open, can give very quick judgments to preserve the status quo, has been to their benefit. And so we're seeing more and more clients do that and take that bold move to salvage the situation. And so it's been a mixed bag. I'm sure that in between all of that, there's any number of other backroom discussions going on. But one thing we found is boards taking proactive leadership, bold decisions, where in the past they would be too worried about the PR angle of calling in a debt or going after a promoter or a group of companies. They no longer have the same sensitivity, because now it's their neck on the line, it's their shareholders' neck on the line, and their funds on the line, and therefore they're having to be bolder. And actually those who are probably better off for it than the ones who are still sitting on the fence, as I said at the beginning. Thank you.
Thank you so much. Mr. Kamilu, just before, you'll take the last question. Let's leave a bit of law. You are presently in management of Aricare. What has been your peculiar experience?
First of all, coming into ARIC, we actually thought that there was some money hidden somewhere, and that was one of the reasons that we appointed the receiver manager. We thought there was some money hidden somewhere in ARIC that we could, basically just come and take. So far, we have not seen the money, but we have a much better understanding of why ARIC got into where they are. Mr. Kunle said something about corporate governance. Yes, ARIC was run as a family business. They were doing big things, and they had very limited number of people in the board. There was no diversity. There was nobody that could look the chairman in the eyes and say, stop, or no, I'm not going to do this or that. So they basically could do anything they wanted. But from sitting here, what I've discovered is that the major reason they are in the situation they are in because of 2 aircraft purchases. More than anything else. They bought 2 planes, 2 A340s for over $200 million. $200 million was enough to buy an MTN license at the time, if you remember, just to put it in perspective. So they bought 2 A340s for over $200 million. It was financed by a big bank. The bank was a big bank then in Nigeria. Their analysis were very poor. They did not understand the aviation industry. Like Mr. Kunle said, the same diligence that a P firm would take to invest, that is the same diligence that you should take to grant some loans, especially large ticket loans. The banking industry in Nigeria has very little or no knowledge about the aviation industry. And at the point of taking credit decisions, they do not even bring experts in to advise them. So where the customer makes a mistake, they just follow and they get into the mistake. So in this case, they bought these 2 massive A340 planes, Airbus planes. They were beautiful planes, but do you know what? They had 4 engines each. Having 4 engine planes means the fuel consumption was going to be high.
Sure.
Within 2 years of the purchase of the plane, they discovered that they were commercially obsolete. They could not cover their costs, how much more make any contribution whatsoever to the payment of the loan. That is over $200 million in the drain. Today, people call it beer can, meaning just turn it back into iron and sell. There's not much you can recover from it. More than anything else, every other attempt they made was covering that hole. Again, when the problem occurred, if there was a more robust governance structure, they would have acknowledged their error early. They would have taken mitigation actions. But no, all through the time we're discussing with them in AMCON, speaking from outside, they never disclosed to us that this was how bad the problem was. They were still making very fanciful projections of incomes coming in, but coming here, we discovered that those were bullshit. There was nothing, there was just no way they could recover that money. More than anything else, that is why ARIC is down. So corporate governance is key. Corporate governance is key, but the banks too can help themselves by having a system that will ensure that when they take large ticket transactions, when they take on large ticket transactions, they don't jump to decision. They are not under pressure. They can consult. They can use the services of consultants before they take decision. But now, so the decisions have been taken and we are where we are. How have we been able to keep ARIC up even in these difficult times? I can tell you that a lot of what has kept ARIC down boils down to the quality of leadership and management. You know, when we came here, we did not just come here alone. Apart from appointing a manager, AMCON and the central bank virtually appointed a technical advisory committee that had the power of a board as far as the receiver manager was concerned. So even though I'm the receiver manager, I don't have all powers. All powers do not belong to me in ARIC. There are decisions that need to be vetted. There are decisions other people need to make inputs into. Now we use experts. When we want to take decisions, we throw it. We use experts. That is why we have survived. Even in these difficult, times, we have survived because we were guided by expert information. We're guided by statistics, data. We did not just jump in. We knew that the industry could not just open in one fell swoop. We knew we couldn't bring all the staff in at the same time. So we were going at it systematically. We knew we had to look after our staff better than we had ever done, the staff that are working. So we took it systematically. I tell you that if any airline business has to succeed, or the banking system, they must be willing to use expert knowledge. They must make their corporate governance system robust. You shouldn't be giving large credits under duress. You must test the fundamentals and be sure that it will work. I have a lot to say, but I know that
our time is running. Our time is almost.
Let me leave it.
Distinguished participants, I will thank you for staying up this till this time. On your behalf, let me thank Mr. Shah, Mr. Elibute, Mr. Rewani, and Mr. Makide for the very incisive contributions. In a nutshell, let me just give it an overview of what each of the distinguished panelists have said. I think Mr. Rewani has painted a very gloomy picture. He asserts that returning into the pre-COVID era is a long run, and hence there is need to prepare for a deep drop before a recovery can be experienced. He also believes that our recovery is also hinged on the recovery of our trading partners. Of course, Mr. Makide has been very emphatic that it is necessary for us to focus on the banking sector to ensure that a financial or further financial crisis is avoided. A joint effort to navigate this sector out of crisis should be embarked upon, as the banking sector is very critical to the growth or to get us out of the present economic issue we've gone through. Mr. Kamal gave us a very international perspective. He says that despite the financial measures in England that have been deployed, some businesses have still been shut down and will still be shut down, as the impact of COVID-19 will be felt for years to come. He says and asserts that the economic toll cannot be underestimated. He also gave us insights into what some clients are doing in the British courts. Now, Mr. Elibute was very frontal. He said that on business failure, that most aids that are granted to the formal as well as the informal sectors are not recognized, and these loans lead to business failures and, of course, subsequent liquidation. He says that before insolvency, every business sees a signal on their balance sheet, and there is need to observe these signals as it affords businesses an opportunity to restructure at that moment, if well managed, to avoid insolvency. He argued that to avoid a flat curve in businesses, there is need for every business to reinvent themselves and also to restrict and comply with corporate governance rules to avoid business failures. Now, distinguished members of the legal profession that are present, we might ask ourselves, what is in all this for us? Aside from being citizens who are impacted by the economic downturn, apart from the fact that we've seen our incomes drop in some cases, I see a ray of hope and opportunities for us as lawyers. As the joke has always been, regardless of the situation in the economy, lawyers will benefit. And why do I say this? One, my learned friends, there is now more opportunities in insolvency for us. As businesses are going bust, banks will have to recall their facilities. So there's business opportunities there. As banks are seeking other restructuring avenues, there will be mergers and acquisitions. There will be schemes of arrangements. There will be voluntary administrations. And all these are well captured in the new CAMA. Of course, there will be labor redundancy disputes. There will be general litigations in relation to credits. PPP projects will still require lawyers. And quite sadly too, where there's a recession or a depression, there'll be more crime. And for those who are skillful in criminal litigation, that's more business for them. With that, I thank you, distinguished panelists, for taking your time. I congratulate the president of the Nigerian Bar Association on this 60th anniversary. I also congratulate the very hard work of the conference planning committee under the leadership of Professor Konyisola Ajayi, SAN. This is our time, and I hope we've been able to add value to you. I thank you very much. My name is Kemi Pinero, SAN. Thank you very much.
Thank you.
Thank you, Kemi.
Thank you.
Excellent session. Thanks, Kemi. All the best. All right, guys. Come here. I'll call you.
Okay, sir.